TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
Hello, TSS traders. We've prepared a summary of the past week for you. Usually, when the President of the United States orders a naval blockade of a major foreign adversary and oil immediately spikes, like $7 a barrel, the stock market plummets.
Right. I mean, it's fundamental cause and effect. You know, the news is the steering wheel and the market is the car.
Exactly. You turn the wheel toward a global conflict, the car swerves into the ditch. Investors panic, assets get liquidated, and everyone rushes to cash.
But what happens when the steering wheel just completely disconnects from the tires?
Yeah, what happens when the underlying plumbing of the market, the options chains, the dealer hedging, the purely mechanical flows, just completely overpowers the real-world news?
Well, you end up with a tape that looks entirely detached from reality, at least to the untrained eye. If you're just trading the headlines, you get run over.
Oh, absolutely run over.
But if you know how to look at the mechanics, if you understand the structural forces underneath the surface, well, that same market makes perfect mathematical sense.
And exploring those structural forces is exactly our mission today. We are looking at a massive stack of incredibly detailed daily market notes.
Specifically the AM and PM briefs from SpotGamma.
Right, the SpotGamma notes, which track what has to be one of the most extraordinary 5-day progressions we've ever analyzed. We are diving into the week of April 13th through April 17th, 2026.
Yeah, a week that begins with a massive geopolitical shock, a military standoff in the Strait of Hormuz.
And somehow ends with the S&P 500 defying gravity, right? I mean, breaking the 7,100 barrier and setting fresh all-time highs amid this insane retail and institutional options buying frenzy.
It really was a frenzy.
So we want to help you understand the underlying mechanical forces that drove this. We're going to map out the gamma levels, the delta flows, a massive VIX expiration, and the towering OPEX that just completely hijacked the macro narrative.
Because to truly grasp the sheer euphoria we saw by the closing bell on Friday, you can't just look at the end of the week.
Right, you have to look at the setup.
Exactly. There is a direct mechanical causal link between the unwinding of that initial panic on Monday morning and the explosive buying that followed. You simply don't get the 7,100 squeeze without the Monday morning fake out setting the trap first.
Okay, let's unpack this. Let's drop right into Monday, April 13th. The macro backdrop over the weekend is, well, it's incredibly tense.
Very tense. Peace talks between the U.S. and Iran have completely collapsed.
Yeah, and President Trump orders the U.S. Navy to begin blockading all Iranian ports. And this order takes effect at exactly 10:00 a.m. Eastern Time on Monday.
Right, and in immediate response, Iran's Islamic Revolutionary Guard Corps, the IRGC, threatens severe military force against any foreign vessels approaching the strait.
Now, just to establish our baseline for you listening, we're looking at these political and military developments purely as catalysts for market volatility and supply shocks.
Right, we are strictly analyzing the market's mechanical reaction to these facts, not endorsing any political viewpoints.
Exactly. But looking objectively at those facts, oil reacts exactly as you'd predict. West Texas Intermediate jumps from a Friday close of $97 all the way up to $104 a barrel in the pre-market.
Yeah, an immediate shock.
And overnight, S&P 500 futures drop 55 basis points. But looking at the severity of the headlines, a 55 basis point drop almost feels like a rounding error.
It is remarkably light. I mean, a major naval blockade and one of the world's most critical oil transit choke points is the textbook definition of a global supply shock.
It really is.
Historically, it's an event that should immediately reprice the entire macroeconomic landscape. If oil transit is threatened, inflation expectations spike, intraday assumptions change, and corporate margins are threatened.
And yet, the options market was whispering a very different story on Monday morning before the opening bell.
Yes. The critical tell was sitting right there on the board in the 0 days to expiration, or 0 DPE options.
Okay, let's dig into that.
Despite the blaring cable news headlines, the 0 DTE straddle for the S&P 500 was only pricing in a tiny $34 implied move. Yeah. At index levels around 6,800, a $34 move is roughly 50 basis points.
Let me formulate what that $34 straddle actually means for the market mechanics. You tell me if I'm looking at this correctly.
Sure, go ahead.
A straddle is when a trader buys both an at-the-money call and an at-the-money put. You are paying a premium to bet that the market is going to have a violent swing, but you don't care which direction.
That's right.
The price of that straddle is essentially the market maker setting the cost of fire insurance for the day. So if the market genuinely believed a major, sustained war was breaking out, market makers would demand exorbitant premiums.
Right.
Because their risk of being blown out on a massive directional move is just incredibly high.
Absolutely. They would be taking on massive risk.
So by pricing it at only $34, the market makers are essentially saying, we see the news, we hear the IRGC threats, but we simply do not believe the market is going to move more than 0.5% today.
You are looking at it exactly right. The options market is a probability engine. It doesn't trade on emotion. It trades on the mathematical likelihood of distribution.
Right.
If systemic risk was truly entering the financial system, the implied volatility component of that 0 DTE straddle would have exploded.
Right.
Market makers would have widened their spreads and hiked the premium to $60, $70, or maybe $80 just to protect their own books.
Just to avoid getting steamrolled.
Exactly. The fact that they held the line at $34 was the footprint of the algorithms calculating that the actual realized impact of the news was going to be contained.
And they were mathematically validated just hours later when a crucial clarification hit the news wires.
Yes, this is the pivotal moment.
This is the turning point of the entire week. U.S. Central Command, CECOM, puts out a formal clarification. The naval blockade targets Iranian ports only. It is a targeted action.
Right.
It explicitly does not restrict general commercial transit or global oil tankers passing through the broader Strait of Hormuz.
And that single clarification fundamentally alters the entire mathematical equation of the market. It separates a localized geopolitical escalation from a global, catastrophic oil supply shock.
The threat to global energy infrastructure was instantly repriced back down to near zero.
Literally near zero.
I think about it like bracing for a Category 5 hurricane. You know, the meteorologists say it's threatening the entire eastern seaboard, so everyone is boarding up their windows, canceling flights, panic buying supplies.
The whole economic engine stops.
Exactly. But then the forecast updates, and they say, actually, the storm is only going to rain heavily on one specific uninhabited island. The storm still exists, the barometric pressure is still low, but for the broader system, the danger completely evaporates.
That's a great analogy.
But here's the behavioral question I want to dig into. When that danger evaporates, do market participants just breathe a sigh of relief, unboard their windows, and go back to a normal Monday?
You would think so, but no.
Because looking at the data, the market didn't just stabilize, it actively went out and threw a massive aggressive party.
Because the market doesn't have emotions, it has positioning. And the positioning coming into Monday morning was heavily skewed toward a disaster that suddenly wasn't going to happen.
Right.
The S&P 500 reversed incredibly hard. It rallied to close at 6,886, up 1.02% on the day. Oil immediately reversed its spike and fell back below $100 a barrel.
But the fascinating part isn't the reversal itself, it's the velocity of the reversal, right?
Exactly. It was a mechanical phenomenon that the SpotGamma daily notes refer to as a seek and destroy mission.
Seek and destroy, it sounds predatory.
It is, mechanically speaking.
Looking at the data, the 99th percentile of 0 DTE gamma-like, the absolute densest concentration of zero-day options exposure, was sitting right around the 6,840 to 6,860 zone.
Right.
And when the index started drifting up toward that zone, we saw the ARO indicator absolutely lose its mind. Let's walk through the mechanics of a seek and destroy event.
Okay, to understand seek and destroy, we have to look at the dealer's book. Prior to that C&T-COM clarification, retail and institutional traders had been heavily selling 0 DTE call options in that 6,840 to 6,860 range.
So they were eagerly collecting premium.
Yes, betting that with a war seemingly breaking out, the market had zero chance of rallying above those levels that day.
Makes sense.
When a trader sells a call option to open a position, a market maker is generally on the other side of that trade, buying it to provide liquidity. Or, conversely, traders were buying puts and market makers were selling them.
So either way, the dealer positioning becomes heavily skewed.
Right. As the news broke that the oil shock was averted, the spot price of the S&P 500 started naturally drifting upward. And as the price gets closer to those 6,840 strikes, the mechanics of gamma take over.
And this is where we need to ensure the listener really grasps the distinction between delta and gamma, because it is the engine of the entire week.
Let's hear it.
If delta is the speed your car is currently driving, say 60 miles per hour, gamma is how hard your foot is stomping on the accelerator pedal. It is the rate at which your speed is increasing.
That is the perfect analogy.
As the market got closer to those 6,860 strikes, the market makers weren't just driving fast. Their foot was mechanically bolted to the floorboards.
Yeah, because as the S&P approaches those sold call options on the exact day they expire, the options become hypersensitive to the underlying price. Their delta expands violently.
And that expansion is gamma.
Exactly. The traders who are short those calls are suddenly staring at massive uncapped losses. They begin to panic by the underlying index or buy back the calls to cover their positions.
Which is a mad scramble to exit.
And we can actually track this exact moment of capitulation using the HIRO indicator from the notes. HIRO tracks high-impact real-time options flow.
So it strips out the noise and isolates the aggressive market-taking options trades.
Right, the exact flow that forces dealers to hedge immediately.
I had to read this specific HIRO chart 3 times because it mathematically is so extreme. Before 12:30 p.m. Eastern, the cumulative net delta flow was sitting around negative $4 billion.
So the market was heavily positioned for a drop.
Heavily.
Yeah.
But after 12:30 p.m., it violently shifts. It rips all the way to positive $7 billion.
Yeah.
That is an $11 billion swing in intraday delta flow in a matter of hours. That isn't a bunch of retail investors deciding world peace is at hand and buying index funds. That is the footprint of a forced liquidation, right?
Yes, and that forced liquidation is a feedback loop. That $11 billion swing represents short call holders screaming, "Get me out," as their sold calls go in the money.
Right.
As they aggressively buy to cover, market makers have to dynamically adjust their own hedges. To stay delta neutral as call buying explodes, the market makers have to buy the underlying S&P 500 futures.
Which just adds fuel to the fire.
Exactly. Their buying pushes the spot price even higher, which puts the next strike level in the money, which forces the next batch of short sellers to cover. That is the seek part. The spot price seeks out the heavily concentrated gamma strikes like a heat-seeking missile, and the destroy part is what happens to the short positions when the hedging flows just wash over them.
The leverage generated by this loop is just astronomical. The PM notes give an illustrative example that I want to highlight. The 0 DTE S&P 500 6,865 strike calls.
Oh, I remember this one.
At noon, just before the IRO indicator flipped, these options were trading for about 50 cents a contract. The market viewed them as essentially worthless lottery tickets.
Right, they were dead in the water.
But by 4:00 p.m., as the seek and destroy loop peaked, those exact same calls were trading at $20.
Wow.
That is a 40x return, a 4,000% gain in 4 hours.
Yeah.
You could have bought a single contract for $50 at lunch and sold it for $2,000 before dinner.
It is the sheer explosive convexity of zero-day options when a gamma squeeze takes hold. But the broader implication is what Monday did to market psychology. The market learned a very dangerous lesson on day one of the week. A massive, terrifying geopolitical headline was ultimately just a fake-out. The bear trap was sprung.
So anyone betting against the market got destroyed.
Exactly. The traders who responsibly hedged for disaster or aggressively bet on a drawdown were entirely wiped out by the mechanics of the options market.
So the shorts are wiped out, the dealers are repositioned. You might log in Tuesday morning thinking things will finally calm down and stabilize. But the underlying mechanics were actually setting up a secondary explosion.
They absolutely were.
To understand why the market didn't just stabilize but actually accelerated violently into Tuesday and Wednesday, we have to pull back the curtain and look at what was happening with volatility, specifically the VIX.
Because Tuesday, April 14th, is where the evaporation of fear truly becomes weaponized.
Let's talk numbers.
The S&P 500 closes the day at 6,967, up another 1.18%. The Nasdaq marks its 10th consecutive day of gains. And the invisible hand driving the index higher wasn't fundamental buying. It was a phenomenon known as volatility compression.
The notes introduce a brilliant heuristic, like a rule of thumb, for trading these specific environments. It states that, roughly speaking, 1 point of a VIX drop equals 50 basis points of an S&P 500 rally.
It's a very reliable metric.
I want to drill into the mechanics of why that ratio exists, because it sounds so clean, but there is a massive amount of algorithmic hedging required to make that happen.
It comes down to dealer positioning and the cost of insurance. The VIX is a measure of implied volatility derived from the pricing of S&P 500 options. When the VIX drops, it mathematically means the perceived risk in the market, the cost of insurance, is falling.
Okay, so insurance is getting cheaper.
Right. Market makers are broadly short index options, meaning they have sold insurance to institutions. When they sell that insurance, they have to hedge against the market crashing by shorting S&P futures.
Right.
But when the VIX drops, the value of those put options they sold decreases. The dealers suddenly find themselves over-hedged.
So to unwind a hedge against a market drop that is no longer happening, they have to actively buy the underlying index.
Exactly. On Monday morning, amidst the blockade news, the VIX spiked into the 21 to 22 range. The dealers shorted futures to hedge. But by Tuesday, as the geopolitical fear evaporated, the VIX compressed rapidly down toward 18.
That's a huge drop.
A 3 to 4 point drop in the VIX, multiplied by that heuristic, mechanically forces enough dealer buying to provide the fuel for a 1.5% to 2% rally in the S&P 500.
Wow.
It is completely independent of whether a stock is actually worth more. It is purely a function of market makers rebalancing their risk models as fear subsides.
And we saw this play out not just at the index level, but heavily in single stocks. With the VIX compressing, the environment became incredibly favorable for taking targeted shots.
Single stocks were wild on Tuesday.
The notes highlight Palantir, ticker PLTR, as a perfect example of how structural support works. Palantir had a key gamma strike, sitting exactly at $130. The stock dropped, touched 130, and immediately bounced.
It was like throwing a tennis ball against a brick wall.
Exactly. That wasn't retail buyers saying, oh, 130 is a good value. That was the dealers holding a massive gamma position at that specific strike that algorithmically supported the price.
And we also saw highly sophisticated players using the volatility compression to make aggressive directional bets. Look at the options flow for Netflix NFLX.
What happened there?
An institution came in and executed massive 100-115 call spreads. They were buying the May 100 calls and simultaneously selling the May 115 calls to finance the trade, laying out $12.5 million in premium.
That is a highly convicted bet.
Very convicted. They are betting that the mechanical compression in market-wide volatility is going to force a powerful directional move upward in specific high beta tech names.
While all this mechanical buy-in's happening, we also have fundamental news dropping. Wall Street banks, JP Morgan, Goldman Sachs, Citi are releasing their earnings reports.
Yes, earnings.
And the headline numbers are spectacular. Goldman reports record equities trading revenue of $5.3 billion, up 27% year over year. Citi posts its best returns in 5 years. The quote directly from the notes is, "The war has been Wall Street's ATM."
It is a phenomenal quote, but it requires a lot of nuance to understand why the market reacted the way it did.
Let's provide that nuance.
Yes, the trading desks at the big banks made billions of dollars because they thrive on the extreme volatility we saw in late March and early April. They are taking a toll on every frenzied trade.
Right.
But if you look deeper at the core banking metrics, the actual fundamental business of lending money, there was significant weakness. JP Morgan actually lowered its net interest income guidance from $104.5 billion down to $103 billion.
Oh, wow.
Yeah. Jamie Dimon's tone on the earnings call was notably cautious about the future. The foundational core of the economy was showing cracks.
But the market completely ignored the core weakness. It was selective hearing. Traders were only listening to the music they wanted to dance to, and they wanted to dance to the trading revenue beats.
They certainly did.
But the tempo of that music was about to get much, much faster, because standing directly in the market's path on Wednesday morning, April 15th, was a massive VIX expiration.
And this is where the underlying market structure undergoes a seismic shift.
Tell us about it.
VIX expiration is an incredibly important, yet often misunderstood, mechanical event. The VIX isn't just an indicator on a screen. It has its own massive ecosystem of tradable options and futures contracts.
Right.
And on this specific Wednesday morning, roughly 5.6 million VIX contracts expired. That represented approximately 49% of all VIX call open interest, and 58% of all VIX put open interest completely vanishing from the board at the opening bell.
The SpotGamma notes refer to this event as the VIX cliff. Let's build out the metaphor they use because it perfectly illustrates the concept of positive gamma.
It's a great metaphor.
Imagine the market is a patient lying in a hospital bed.
Yeah.
And the aggregate VIX options open interest is a heavy lead blanket draped over them. That blanket is heavy. It restricts their movement. It keeps things contained and stable. That blanket is what we call a positive gamma environment.
It is the perfect way to visualize it. If we connect this to the bigger picture, when market makers are net long VIX options, which they often are, they are operating in positive gamma.
Okay, so what does that mean for them?
What that means for their hedging algorithms is that they are forced to trade against the prevailing momentum. If the market drops, implied volatility usually rises, meaning the VIX goes up.
Right.
The dealer's VIX calls make money, increasing their portfolio delta. To get back to neutral, they have to sell S&P futures. Conversely, if the market rallies, the VIX drops, their VIX calls lose value, and they have to buy S&P futures.
Okay, I follow.
The net result of all this complex math is that dealers are constantly buying the dips and selling the rips. They act as massive institutional shock absorbers. That is the lead blanket dampening the volatility.
So, Wednesday morning arrives, 9:30 a.m. Eastern. 5.6 million VIX contracts expire. The heavy lead blanket is instantly yanked off the patient. Here is the logical question that a trader must ask.
What's that?
If you remove the blanket that has been keeping things calm, you would naturally expect the patient to start thrashing around. You'd expect the market to get choppy, maybe experience a sharp drawdown as fear is suddenly allowed to freely creep back into the pricing. But instead of bumping down, the market absolutely exploded upward. Why did the removal of this vol-suppressing blanket lead to absolute euphoria instead of chaos?
Because removing a dampener doesn't dictate the direction of the subsequent move. It simply amplifies whatever force is currently dominant in the tape.
Oh, that makes sense.
And the dominant force, engineered by the Monday bear trap and the Tuesday VIX crush, was aggressive leveraged call buying. The momentum was already pointing strictly up.
Right.
Without the positive gamma blanket of dealer hedging to slow the market down, without the algorithm selling the rips, the call buyers faced zero resistance. They were able to push the S&P 500 through key technical levels because the opposing friction had literally expired.
And that vertical acceleration carries us right into the chaos of Wednesday afternoon and Thursday. By Wednesday afternoon, the S&P 500 hits a new all-time high of 7,023. By Thursday, it's pushing towards 7,050.
It just kept going.
It entirely recovered from the brief Iran conflict drawdown and is setting absolute records. The 7,000 strike became this undeniable magnetic force.
Round numbers like 7,000 often act as psychological barriers for retail investors, but in the options plumbing, they are mechanical battlegrounds. There was a tremendous amount of open interest concentrated precisely at the 7,000 strike.
Let's look at the HIRO flow again, because the data for Wednesday is just staggering. At 1:00 p.m. Eastern, the net delta buying hit positive $15 billion.
That's huge.
The SpotGamma notes explicitly state this is one of the highest HIRO readings they have seen in the past year. Walk us through the anatomy of a $15 billion delta wave. What does that actually do to the market ecosystem in real time?
It creates an absolute vacuum of liquidity on the upside. Market makers are broadly short those 7,000 strike calls that retail and institutions are frantically buying.
Okay.
As the spot price of the S&P rapidly approaches 7,000, driven by this $15 billion wave of aggressive buying, the market maker's short delta position expands exponentially due to gamma.
Right, the gamma squeeze again.
Exactly. The closer it gets to 7,000, the more painful their position becomes. They are forced to step into the open market and buy the S&P 500 indiscriminately at any price just to hedge the risk.
And there's no blanket.
Right. Because the positive gamma blanket from the VIX expired that morning, there was no offsetting dealer flow to provide friction. It is just pure, unadulterated buying pressure feeding on itself.
The result was another convex explosion, even more violent than Monday. The 0DTE 7,000 strike calls surged from $3 a contract at 1:00 p.m. to $21 by 3:00 p.m.
Incredible.
That is a 700% gain in a 2-hour window. And this mania wasn't confined to the index. The retail and single stock frenzy was happening simultaneously, amplifying the index-level moves. Tesla is the absolute perfect case study of this dynamic in action.
Tesla is arguably the most financialized stock in the modern market, meaning its daily price action is often dictated far more by its options flows than by its actual automotive fundamentals.
Right.
On that Wednesday, Elon Musk announced the new AI-5 chip. From a fundamental perspective, it is a nice catalyst, a good headline. But mechanically, it was throwing a match into a powder keg of options positioning.
Let's unpack the Tesla chart for that day, because the levels are so clean it looks scripted. Tesla had been pinned. It dropped, bounced perfectly off a key gamma strike at 360, and then it began squeezing upward right toward a massive call wall at 370. For you listening, a call wall is simply the strike price that has the absolute largest concentration of call option open interest. It usually acts as massive resistance. Dealers are short those calls, and they defend that level. But what happens when the buying pressure is so intense that the price actually breaks through the wall?
When a stock breaks through a major call wall, the mechanics invert violently. The dealers who are defending that level suddenly find that all those short calls are now in the money. The delta goes to 1, the gamma goes nuclear.
Oh, wow.
The dealers have to immediately capitulate and buy massive amounts of the underlying stock to cover. When Tesla broke 370, that dealer capitulation kicked in, and the stock rallied 8% on the day to close at 392.
And the options pricing on that move is where fortunes are made and lost. The April 390 calls went from 50 cents a contract to $9.
That's an 1,800% gain.
That is life-changing money for a retail trader on the right side of that flow. And it is an absolute margin call bloodbath for any fund that sold those calls naked, thinking 390 was mathematically impossible.
And this is where we have to step back and diagnose the structural health of this rally. Is this a sustainable, fundamentally driven bull market built on corporate earnings and economic growth? Or is it a fragile, hyper-leveraged mechanical squeeze built on options flows?
That's the million-dollar question.
The SpotGamma notes identify a specific, highly abnormal condition that emerged across the board on Wednesday and Thursday that answers that question.
Okay, I am looking at this specific chart for Thursday, and it fundamentally breaks one of the core foundational rules of options pricing. Here's where it gets really interesting.
Let's explain it.
Let me frame this. Normally, the relationship between the stock market and volatility is inverse. When the S&P 500, the spot price goes up, investors feel safe, they sell their put option protection, and implied volatility goes down. Spot up, vol down.
Right, that's the standard behavior.
Conversely, when the market drops, fear rises, investors panic buy puts, and volatility spikes. Spot down, vol up. It makes perfect intuitive sense. You buy fire insurance when the house is burning down, you don't pay a premium for it when it's 75 degrees and sunny.
Exactly.
But the SpotGamma data shows that on Wednesday and Thursday, fixed strike implied volatility was actually increasing across most expirations while the S&P 500 was rallying to new all-time highs. Spot up, vol up. People are paying more for insurance while the sun is shining. Am I reading this right?
You are reading the data perfectly, but you have to change your definition of the insurance policy to understand the behavior. They weren't buying protection, they were buying lottery tickets.
Oh, I see.
Spot up, vol up means that traders were so desperate to chase the rally, so utterly consumed by the fear of missing out FOMO, that they were aggressively panic buying upside call options.
Right.
They were buying them with such volume and with such complete disregard for the ask price that market makers were forced to raise the implied volatility on those calls just to mathematically compensate for the massive directional risk they were taking on by selling them.
So it's not a sign of fear. It's a sign of a leveraged buying spree. It is momentum chasing, reaching a fever pitch. It is not fundamental investing allocating capital. It is pure speculation driving the underlying asset through the derivative tail wagging the dog.
Precisely. And we can visualize this exact shift in market sentiment. The notes use a proprietary visualization tool called the options compass.
I love the compass.
It maps out where individual stocks sit based on two metrics: how expensive their volatility is, and whether the options flow is leaning toward puts or calls. Earlier in the month, top tech names were clustered in the lower left quadrant of this compass.
What did that mean?
That meant their options were relatively cheap and the flow was heavily put-weighted. People were responsibly protecting against downside risk.
But by Thursday, the compass showed a massive, chaotic dispersion. Top names rotated aggressively from the lower left to the upper right. They became incredibly expensive and heavily call-weighted.
Yes, a complete shift.
NVIDIA, ticker NVDA, was explicitly noted in the briefs as shifting from cheap and put-weighted to heavily call-weighted. Everyone abandoned the lifeboats, ran to the top deck of the ship, and started demanding more leverage.
Which brings us to the precipice. By Thursday night, the underlying data paints a picture of a market that is utterly exhausted from going up. It is structurally unbalanced, severely overbought on a mechanical level, and it is staring down the barrel of a massive historic options expiration, or OPEX, scheduled for Friday morning.
And that brings us to Friday, April 17th, OPEX Day. The macro news officially confirms the bull case that the market priced in on Monday. Iran formally announces they are keeping the Strait of Hormuz open for general commercial transit.
The geopolitical risk premium completely bleeds out of the system.
Oil plunges all the way down to $83. And the S&P 500 closes the week at an astonishing 7,126, up another 1.20% on the day. On the surface, it looks like a perfect, fundamentally justified soft landing.
But underneath the hood of that 7,126 closing price, the market mechanics are flashing bright red warning signals. Friday was OPEX, and the sheer size of the expiration rolling off the board was historic.
Let's talk about the absolute scale of these numbers. The notes reveal a staggering $910.9 billion in expiring delta notional.
Nearly $1 trillion.
Nearly $1 trillion of options exposure is rolling off the board in a single trading day. 58.3% of that massive figure was tied directly to the S&P 500 index, and 31.5% was tied to single stocks.
The total size is massive, yes, but the composition of that expiring delta is what's truly dangerous. This wasn't a balanced, healthy expiration.
Not at all.
The expiring delta for the S&P 500 was heavily dangerously skewed. It was 89.3% calls and only 10.7% puts. For single stocks, the imbalance was 82.7% calls.
Let me stop right there. 89.3% calls. That means nearly 9 out of every $10 of expiring index exposure was a bet on the market going up.
Yeah.
Mathematically, how does an open interest pool get that incredibly lopsided? Because for every single option bought, someone had to sell it. How does it end up 9-1?
It is an incredibly rare, historically extreme imbalance, and it is the direct mathematical result of the S&P 500 rallying 11% in just 2 weeks. When a market moves that far, that fast, the moneyness of the entire options chain shifts violently.
Makes sense.
Think about it. All the put options that people bought for downside protection weeks ago, far below current prices, have become virtually worthless. Their delta drops essentially to zero. They don't factor into the expiring delta calculation anymore.
Right.
Meanwhile, all the call options that were way out of the money suddenly become deep in the money. Their delta goes straight to 1. So the aggregate expiring delta becomes overwhelmingly skewed toward calls simply because the market outran the entire chain.
And the retail frenzy was just echoing this index imbalance everywhere you looked in the single stock space. The notes highlight price action that is purely manic. A stock with the ticker BOOR was up 300% in 2 days simply because management announced a pivot to AI.
Just on a headline?
HIRO was up 300% in 2 weeks.
Mm-hmm.
But there's another data point in the notes that I found even more telling. There was a mysterious, massive surge in non-zero DTE call volumes.
Yeah, that's key.
Usually, the degenerate high-leverage gambling is contained in the zero-day options. But suddenly, the 1 to 7-day and 8 to 30-day options volumes were blowing out.
That specific surge suggests the FOMO wasn't just contained to retail day traders flipping zero DTs. It was institutional players, swing traders, and larger retail syndicates leveraging up for a multi-week continuation of the rally.
They were betting it would just keep going.
Exactly. They were looking at an 11% move in 2 weeks and aggressively betting that the trend would persist into the next month. They were buying time and leverage.
Okay, I have to push back here, or at least play devil's advocate for the listener. Put yourself in the shoes of the average trader looking at their screens on Friday afternoon.
Okay.
The S&P is at all-time highs. Oil is down to $83. The Strait of Hormuz is officially open. The geopolitical crisis is completely averted. Everyone around you is making money hand over fist on upside calls. The trend is clearly your friend.
That's what the screens say.
Why, in the face of all this undeniable, universally bullish price action and macro news, are the SpotGamma notes aggressively warning about a 2% correction next week? Why on earth would you fade this tape?
Because of the OPEX mechanics we've been tracking all week. We have to go back to the concept of the positive gamma blanket we discussed with the VIX expiration.
Okay, remind me.
When there's a massive amount of call open interest, market makers are generally short those calls, but they have been hedging that short call position by buying the underlying stock as it goes up. As long as those calls exist on the board, the dealers are operating in a long gamma position on the broader index. This means they are dynamically trading against the trend to stay neutral. They're the ones buying when the market dips a little and selling when it rips a little. They are providing the liquidity that dampens volatility and supports the elevated price.
They act as the scaffolding holding up the building.
Precisely. But OPEX is the day that scaffolding is scheduled to be legally dismantled. That $910 billion in expiring delta. A massive chunk of that is the exact positive gamma that forced dealers to support the market all week.
Wow.
Once those contracts officially expire at the close on Friday, the market becomes mechanically untethered. The dealer hedging flows that were artificially holding the market up or pinning it at the 7-100 strike just vanish into thin air.
But just because the scaffolding is gone doesn't automatically mean the building falls down.
Right.
It just means it's unsupported.
Correct. If the building is structurally sound and perfectly balanced, removing the scaffolding is fine. But if the building is leaning heavily to one side, Removing the scaffolding is catastrophic.
And it was leaning.
Oh, heavily. And we know definitively that the market was leaning heavily. We can mathematically measure how unbalanced it was by looking at the spread between implied volatility and realized volatility.
Realized volatile is the rearview mirror. Implied is the windshield. The market just rallied 11% in 2 weeks. That is a violently fast, chaotic move. The realized volatility, the actual day-to-day whiplash we just experienced, is sitting high at 18.9%.
Right.
But the VIX, looking forward through the windshield, closed at an incredible complacent 17.47.
The windshield expects a significantly smoother ride than the rearview mirror just showed us. When implied volatility is severely discounted compared to realized volatility, it means options. The cost of insurance are statistically very cheap. The market has grown complacent.
They think the danger is past.
It has priced out all future risk despite just surviving massive volatility. When you combine a deeply overbought market, an 11% rally in 2 weeks, an 89% call imbalance, extreme spot-up, vol-up FOMO, with the sudden removal of the dealer positive gamma blanket, and historically cheap options pricing well, the mechanical setup heavily, undeniably favors a sharp mean reversion, a correction.
The rubber band is stretched as far as it can possibly go, and the algorithmic fingers holding it back are letting go at the Friday close.
Yeah.
So what is the actionable intelligence here for the TSS trader?
That's what it all comes down to.
The recommendation derived from the sources is clear. The risk and reward setup heading into the next week heavily favors long volatility structures, straddles and strangles.
And the math supports that trade. Because implied volatility is so low, the VIX is sitting at 17.47, it is relatively cheap to buy both a put and all call to form a straddle. If the market corrects sharply as the gamma blanket rolls off, your put prints money and volatility spikes, inflating the overall value of your options. Even if the market somehow defies gravity and continues to explode higher, the call side of your straddle protects you.
So it's win-win if there's movement.
Exactly. The only way you lose on a straddle in this specific environment is if the market just sits perfectly, completely still. And given the removal of the dealer pinning flows, a perfectly still market is statistically the least likely outcome.
Makes total sense.
Selling premium here, writing naked options to collect a tiny yield, is like canceling your flood insurance while standing in a puddle just because the rain briefly stopped. It is an asymmetric risk to the downside.
That is an incredible visual, canceling your flood insurance in a puddle. So let's synthesize the takeaways from this extraordinary week for our listeners.
Let's do it.
April 13th through the 17th was an absolute masterclass in how options market positioning completely hijacked the macro narrative. We watched a legitimate, terrifying geopolitical crisis, a naval blockade, and a pre-market oil spike get neutralized in a matter of hours.
Not by diplomats or politicians.
No, but by the mechanical covering of short zero DTE calls in a seek and destroy loop. We saw the S&P 500 squeeze to a record 7,126, driven by a 5.6 million contract VIX expiration yanking off the lead blanket.
And a $15 billion HIRO delta wave.
Exactly. And retail FOMO that inverted the natural laws of volatility to create a spot-up, vol-up environment.
The defining lesson of the week is that reading the news is no longer enough to trade successfully. The headlines are just the starting gun. They don't tell you the route the race will take. To survive and thrive in this era of volatility, you have to read the tape and understand the plumbing.
The mechanical flows.
Recognizing those seek and destroy gamma levels allowed traders to anticipate the Monday and Tuesday squeezes while the rest of the world was panicking over oil. Monitoring the HIRO delta flows provided the exact roadmap to understand that the Wednesday rally was a mechanical panic to buy, not a sudden surge of fundamental conviction.
The options plumbing of the market is actively dictating the price action of the underlying assets.
It's the tail wagging the dog.
We just watched the broader market perfectly price in and instantly discard a war scenario, all while options mechanics push the S&P 500 up 11% in 2 weeks. It begs the question, and this is what I want to leave you with. Have we reached a point in modern finance where fundamental real-world news no longer drives the market's ultimate destination, but simply serves as the spark that ignites pre-existing options traps?
It's a heavy thought.
Think about your own trading strategies next week when the positive gamma blanket is officially gone. The shock absorbers are off. The car is moving incredibly fast, and the steering wheel might just be disconnected. How will you navigate the road ahead? Thank you for joining us on this deep dive. Until next time, keep your eyes on the data.